It's Nicola Downs from Trentham Invest. I want to talk about the portfolio design and build and monitoring service that we provide at Trentham Invest. So back in 2000, I had a lot of people over a number of years, perhaps 4 or 5 years, saying things like, I've invested my money into ISAs, I'm doing the right thing, however, I might as well have put my money in the bank. So having heard a number of people say the same thing, I thought, well, maybe there's some truth in this. So let's dig a bit deeper as to understand a bit more about why and what's going on. So the study we did was over 2000 to 2008, and then also did another 10-year study from 2009 to 2017. Interestingly, what happened in 2000 to 2008 was that the people were right. And what was right was the outcome was they were taking a lot more risk with their portfolio, and the result was similar to the returns that they could have got in the bank. And looking at that, the reasons is that they were very transactional, very herding, looking at what was in the papers, what were the hot funds to go into, and do what really everyone else was doing. And what that meant was that they were buying high and not really getting the upside of any investment returns. There was no advisor advising them, and it was just very faddy and very fashionable funds that they were picking. So not a good method to deploy at all. So what we then looked at and compared was a structured portfolio that was done by logic, not emotion, that had a science behind it, a methodology behind it, a determined level of risk behind it. Our scale is 1 to 10, 1 is low and 10 is high. Most people don't want 10 because they think that's too hairy-mary. However, what they were doing by themselves is probably about a risk 20 anyway. So we then plotted the results of that, and you can see that even a risk 10 is far less risk than what they're doing themselves, and a risk 3 is delivering more returns than money in the bank, as with every other portfolio. So that was a real game changer and a real insight to see the results of our method versus what people are doing on their own. So we call it the red dot and versus the green dots, and you can see the red dot is what people are doing themselves, and what we want to do is really to get people onto the green dots and away from the red dot. The study that we then did 10 years later on came out with the same kind of results, however, in a completely opposite fashion. So their behavior over the next decade meant that their choices were much lower risk with lower returns, and yet the portfolios were much higher risk. So, and again, that's all driven by emotion and what's written in the newspapers and fads and hot funds and things like that. So not really good way to build your portfolio, your wealth, and actually to get that working for you. So what are the sort of things that we do? Well, we look at, and I hear from people, they say things like, well, it's different this time, and actually we take a 10-year view on expected returns of different assets. Things like cash, bonds, fixed interest, property, UK equities, global equities, Far East, etc. And when we look at a 10-year behavior of each of those, they're roughly the same. So we can very accurately predict the behavior of the portfolios because we're looking at a 10-year view, 10-year horizon, and we find that most things are the same. So pulling those structures together, we then look at who's the best fund manager, and this is where things do change. and looking at the best fund manager in there, it's important that we want somebody who's going to be proactive. We want somebody who is going to be a real specialist in their area. And as the world gets more and more complex, there's more and more data, more and more information out there. Which funds do you choose? Which stocks do you choose? Which shares do you buy? And so on. Then you really need a specialist team to take care of a specific area. So that's what we do is say for UK equities, we will find fund managers who are very specific in that area and who know the market inside out. So it really does need a lot of specialism. And as I say, I think with the world the way it is, getting more and more complex, then a team of specialists is the way forward. So we've been doing that for nearly 2 decades now, and with a lot of success. So we'll do the same in the area of property. We'll do the same in the area of global equities, Far East, and so on, picking up those top fund managers. We'll shortlist down to about half a dozen, and then once we've got that half a dozen, we'll go in and drill with more data and more information to find those that are winning because they are taking the right amount of risk, or they're doing what the fund mandate is supposed to be doing, and not people who are taking more risk than what they should be just to get those results. So having pulled all of those things together, we then come up with a team of fund managers, and there's about 40, maybe between 35 and 40 fund managers per portfolio, all pulled together, gives us that green dot outcome. My company's mantra is to get people off the red dots onto the green dots to make sure that their money is working to the best for them, and so they've got no worry, they're not awake at night, they know that their wealth has been carefully taken care of and working to its best.